Hey everybody, Signet here with the OEC. In this video we're going to talk about price action in a basing pattern or in a ranging pattern, and we're going to talk a little bit about perspective. Every single thing that we do is based off of this simple logic, and it doesn't matter what time you apply it to, the same logic applies across the board. Okay, when you've got an opportunity to take a trade, you have to ask where your stop is going to go, where price action is going to go. So let's start building this so that it gives us some perspective. It'll look a bit like, let's try these different ones. There we go. Look at this right here. So now we've got a very clearly defined range. And from this range, we had the breakouts that failed. It's not a surprise. Breakouts fail over 80% of the time. And this is an example of that. Now, sooner or later, price is going to break this range and finally hold that breakout. And there's nothing that can tell you that it's going to be the one. You have to take your opportunities, right? Now, there's still entries that we can take. There's defined things that we can do to help avoid getting chewed up. One of those is a Busby. All right, so when we had a break here and it went to the downside, when it came back up, we would be looking for a Busby here to confirm our move down, and instead it came right back inside, so we didn't get that trade. Right? Same thing up here. We broke to the upside, we're looking for a Busby, we didn't get it. Right? It just fell right back in again. Now here we did get a Busby. It broke out of the range, it came back down, let us in, it started to run, and then it stalled. It failed, and it came back down again. Right? So if you do get the Busby, you can take it for the ride, use your money management. This would have allowed you to get into the trade and make a little bit of money before it stalled. So you don't have to jump into this every single time it breaks out. But I would recommend that there's more than one way to trade this. That you don't have to wait for a Busby at all. It's a clearly defined range. From these lows, you can look to take it back up. And then from the highs, you can look to take it back down. Right? Then you would already be in the trade as it's breaking out from there. Okay? So there's a lot of different ways to do this. The thing is, we get in a hurry, or we don't want to wait, or we think it's going to leave us behind and that we're not going to get our chance. And so we jump the gun and we get in, and then we can't hold it, or we don't trust it, or we don't believe it, and we get back out and it leaves us behind, and we end up not taking advantage of the opportunity that was given to us. This 30-minute time frame could have give us this really great example or this really great perspective, but we can find this same thing in a 2-minute chart or a monthly chart or a daily chart. It doesn't matter what time frame it is. These same patterns repeat themselves. And it all comes down to how big is your account, how much time are you willing to sit in front of the computer, right? So in this kind of situation, on a 30-minute chart with these big moves, we would want to risk 10 or even 15 points, right? Because we're looking for 80 to 100 point moves. I will risk 10 to make 80 any day, right? But I'm not going to risk a 10-point stop on an intraday basis when I can't see a target farther than 10 points away, right? I'm not going to risk 10 to make 10. Excuse me, sorry. I will not do that. I won't make that kind of risk. I want to risk 1 to make 4, 1 to make 5, right? Risk 5 to make 40, not risk 10 to make 10. That doesn't work for me, right? you also need to know your win rate. If you trade the same thing all the time, you get your win rate, right? You have statistics and numbers behind it. You can journal your work and keep track of your trades. But I promise you, you can gain experience from trading and you will have a feel for how things work. Now, nobody wants to talk about gut and instinct and just it feels right, but it's a real big part of trading. When you are walking around, you change your balance, you react to the uneven floors, you walk without even thinking about it. You just react and adapt. That's how your trading is supposed to be. Yes, there's things we want to look for. There are a lot of different things that we can do to put edge on our side. There's a checklist of things that we want to look at. But in the end, it also needs to feel right. It needs to feel like something you've seen before. It's a friend. It's something that you recognize. Oh, I've seen this. I know what this is. I saw this last week. You won't get that from a checklist. You get it from experience. There's no way to get experience except just to do it. So stick to what is right. Stick to best practices, protecting your account, surviving to trade another day, because that's the only way you will get experience. So once you eliminate the stuff you should not be doing, the things that are left are there to protect you. Stick with them. Allow them to help you. This pattern that we're looking at here could be any time frame at all. I could have narrowed down this video to where you couldn't see the time up here, and you would not have known if this was a 30-second or a 30-day, right? It all comes down to the pattern, the setups, the opportunities. So if you're going to get into a trade, look at how much you have to risk. Look at where your stops should be. Look at how big your stop is, and if it doesn't fit that time frame, or it doesn't fit your account, or it doesn't fit how much you think you could make, you don't belong in that trade, right? Look at these breakouts up here. These are 20-point breakouts that failed. You would need plus 20% here, plus 20 points to take a trade with that kind of stop level. That's huge. If I'm going to risk 20 points, I better be looking at 100-point moves, or I'm not doing it. Everything you do has to fit the time frame that you're trading, and this is where so many people just get it so twisted around. Look at the ATR here, right? We're looking at 30.60 all the way up to 31.20. That's a 60-point range. We could just trade the middle all day long, but where would my stop be? If I'm going to get in the middle of this, my stop has to be out here. It has to be outside the box. If that is too far away, I just can't take the trade. So that means I can't use the middle, right? Well, then I'm going to have to wait for it to get to the edge. Let it validate, and then get in. But even if I got in at the edge, where's my stop? Well, this is already proven it will take me to the lows. I'm going to need my stop below that. All of that tells me that this time frame is too damn big because I don't want to risk a 20-point stop for a 60-point move, right? Just that easy. You can look at the math here and say that don't work. Now, we're getting the opportunities here to be able to trade this back up, that we could get in below 30.20, and we wouldn't have to risk very much at all, right? If this even looks remotely close to being acceptable, we could begin looking for an opportunity to trade this. What's my chances that it's actually going to hold the line and go up from here? Or what's my chances that this is just a drawback and it's going to continue to go lower? We don't have to guess. We can wait. We can let it play out. Now on this time frame, we're looking at risking, let's see, we're at 33. That's 13 points. Are you willing to risk 13 points to make 73 points? If that feels comfortable to you, you could pull the trigger right now and put your stop below 30.20. You wouldn't really need to trigger that stop to know that you need to get out, right? You could look at this and you could say, well, okay, I'm going to put my stop here, but I'm going to watch the market. And if this starts to look like it's failing, I'm going to give up on that long trade and just get out. I don't need to let the stop tell me that I'm wrong, right? I could just get out. And all of that is impatience anyways, because we could just wait for this to give us the answer that we're looking for. If you can't see the trade, don't take it, right? So if you're looking at this and you're saying, well, I don't know, it's 50-50. It could go up, it could go down. Fine. What do you need to see to convince you that it really is a short or that it really is a long? Is this a pullback on its move lower, or is this a market reversal? That is the only question we need to answer right now. Here's my trend down. Are we building a base to move up, or are we just pulling back before continuing our move lower? We don't have to guess. We can wait to get that answer. If this is a move back up, we're looking at a 60-point range. We only need to get some of the middle, right? So let it validate. If it comes back down here and tags this low and begins to work itself back up, there's your entry. You couldn't get less risk at that point. All you would have to do is wait for it to come down to this level. Look, right now we're getting this green run to the upside. You would only have to risk the bottom of this wick here. 10 points for a 60-point move. That's your opportunity to get in. Do the math, guys. Crunch the numbers. Look at how much you have to risk for the chart time frame that you're looking at. If it doesn't fit, then get into a smaller time frame. If 5 minutes doesn't fit, then get into a tick chart, because you don't want to go below the 5 minute. Guys, I ran out of time on this one. I'll see you in the next video.